Meantime, more Fed speak, less clarity. The debate over June's meeting continues as Cleveland's Loretta Mester signaled that concerns Fed policy is not yet tight enough, but for others, voiced opposing views. Our next guest says the Fed's struggle to decisively communicate remains a key challenge. Eric Theoret is Manulife Investment Management Global Macro Strategist, and he's here with us in studio today. Eric, welcome. Thanks for being here.
Thank you.
So, the Fed always gets criticized, right? For what are they going to do? Are they communicating well enough? But now is an interesting time in particular because you do get sort of conflicting or at least diverging to some degree views. How much of a problem is that?
Well, I think it's a problem in as much as, the Fed has a dual mandate. Inflation has a goal of 2% and full employment. And the Fed is still far away from its inflation or price stability mandate. So I think coming into the last meeting, there was this expectation that the Fed was kind of delivering an implied pause, and then the next piece of the puzzle was to really manage the forward guidance and the outlook. Markets have gotten a bit ahead of the Fed in terms of pricing and easing as a result of the data that we've seen. But the Fed, it seems to be now, and obviously what we're discussing at this point, is that there's still a bit of dissenting views around whether we've actually reached that terminal rate. And so I think that's the big debate right now is, does the Fed maintain the current level and then keep it for a while longer, or does it continue to push higher? But that just means, I think, a bit more tightening in terms of the economy, headwinds to growth, and then probably a bit more of a deceleration on the backside of that.
I know this 2% target has been out there since the Fed has been communicating it. Perhaps it's time to bump it back to the top of the inbox, though. Why is 2% the right target for the Fed here?
Well, I think, if this is something that was arrived at decades ago by policymakers around the world and, debated academically, there's a debate about 0%, 2%. Some emerging markets even have, 3 to 4. So it really is a policy preference depending on the country. But across developed economies, it's generally 2, and it's seen as, I think, a level that's acceptable.
A level that's acceptable, if not attainable, perhaps right now, right? So when we keep talking about how the markets are still pricing in a cut by year's end, despite the fact that the Fed really seems to be signaling that's not the case. What is the risk in that gap in what they're saying and what the markets are predicting?
Right. So I think, when we look at the inflation story right now, it's vastly different than what we've experienced in decades past, right? And so the historical analogs that we've had to assess the Fed's policy response or the policy reaction function is a bit different this time, in the sense that inflation is still well above target. And so the Fed just doesn't have the ability or the cover to actually deliver the easing that the market wants to basically price in. So until we get inflation really under control, we're a long way off from the Fed being able to deliver on the cuts that the market's pricing.
Does the Fed tip us into a shallow, mild, more severe recession even than is anticipated right now?
Well, I think that's the challenge, right? It's the whole debate about the soft landing. Are we going to be able to achieve it? So far, so good. Actually, so far, the data have been even more resilient, which is why we're having the debate about notching up that terminal rate. So I think overall what we have is an economy that's operating above demand, inflation that's still very hot. These are good things from a perspective of economic activity, but it's just delivering inflation that's well above kind of our comfort levels. And so that's the challenge for the Fed right now, is do they tighten even further, give us greater headwinds to growth, and then really start to decelerate the economy in a way that would achieve more of a hard landing than a soft landing in order to get back to 2%.
I want to ask about the debt ceiling as well, because that's the other sort of overhang for markets here. What we had in 2011 was that we got a downgrade of U.S. debt even after they came to an agreement on the debt ceiling. What's going to happen this time?
Well, I think
tell me right now, exactly what's going to happen this time?
Well, I think at the moment, looking across markets, it's a very calm sentiment picture, right? So volatility is low, the S&P's been stuck in a range, just limited movement across asset classes. I think the challenge is these are risk events that are typically very short-lived. They're typically classic risk-off episodes. You'll see, strength in havens like the Japanese yen, the Swiss franc, even gold, and then weakness in the U.S. dollar against some of the other G10 and emerging market currencies and risk assets more broadly. I think the challenge, again, this time is that, emerging markets are in a much better place. Their interest rates are much higher. And I think for the U.S., it's a very different geopolitical situation where I think there have been kind of questions around the U.S. dollar's role in the global economy and the global financial system. And it's just not probably the best time to be maybe calling that into question, especially if you're doing it yourself. And so I think that's the big challenge is obviously there are repercussions to what's happening right now. Obviously markets are calm, but if we look at the 2011 episode, it does have the potential to be a negative risk event for sentiment.
And so what is the correct portfolio pivot then if you are concerned about that?
Well, I guess there's two ways to play it. You can position for the kind of risk off episode that, may happen, or be ready to kind of buy when that risk off episode does happen. Because again, as we saw in 2011, that risk off episode was very short lived. And so anyone who was kind of ready and willing to pounce would have done quite well.
Is there also an argument to be made to look outside of the United States right now, or will there be pretty dramatic spillover effects if there is a worst case scenario here in the U.S.?
Well, again, I think it depends on what asset classes you're speaking about. So if you're looking at equities, we've obviously seen continued weakness in emerging markets. And so although I just mentioned emerging market currencies, I think in terms of equities, those are still looking quite weak. For Europe and the rest of the developed economies, those are actually doing quite well versus the U.S. And so I think if you want to play a U.S., non-U.S. piece, you'd want to play non-U.S. developed.
Eric, thanks for coming in. Good to see you in person. Eric Theoret is Manulife Investment Management Global Macro Strategist. Thank you.